Well, hello, everyone. This week we have a very special guest I'm very excited to interview. I've seen a lot of his discussions over the last year or two, and he talks quite a bit about one of our top stocks, Lemonade. And so, yeah, I'm very excited to have PaperBagInvestor on the call or on the video interview today with us. Nice to meet you.
Thanks. Thanks for having me, guys. Thanks. Good to meet you guys as well.
Sure. So
Yeah.
I don't know if anyone has heard of PaperBagInvestor, but he's got a great channel, really interesting. Does all his interviews with his, PaperBag doesn't want to reveal his identity for personal reasons maybe or whatnot. Yeah, just give us a rundown of that if you don't mind for people that are new to you.
Yeah. PaperBagInvestor. I like to try and look in detail, in depth at companies. Try and find huge potential winning stocks. Why do I wear the paper bag? Partly, it's a marketing gimmick. I'll admit that.
Okay.
Partly, it's I'd be open to doing a face reveal maybe someday that might come, but it's nice to stay anonymous on the internet.
Sure.
And then partly, it's like partly kind of like a metaphor or example of challenging your assumptions. Like at the opposite end of a spectrum. A lot of people, especially in I think the finance world, maybe not for people like us because we're all on YouTube and YouTube's maybe even kind of viewed to that one side, but the opposite would be, you think image is sort of everything. You're in the tall tower of Wall Street and you're in a fancy suit and you have a fancy degree and letters, and that's the most important thing. And it's sort of the opposite. Like that doesn't mean that's not important or not valuable, but really, the value should come from kind of like the analysis itself. So it's almost like putting on a clown costume or something, and then
I like it.
Showing people like right away. Like some people I know would take offense at the fact that you have a bag on your head. Like that's just wrong. You're an idiot, But I think a lot of people can kind of see through that and then kind of realize, and that's sort of what I'm trying to convey to people. Like you should look deeper at your investments and not just have sort of a surface cut reaction to like a feeling reaction or some kind of a biased reaction in that way. So
And you interviewed actually the CEO of Lemonade recently, right? A few weeks ago or a month or two ago, Daniel Schreiber.
No, it was good. It was pretty great.
How did you kind of get that? You just kind of reached out and he agreed, or you reached out multiple times and finally agreed, or did you have a special connection? I mean, that's pretty big deal to it's not like you have 200,000 subscribers.
For
you
sure.
have you're a small up and coming channel like us, and you got a big match on that. That was impressive.
It was unexpected. Just I had connections with Daniel and Shai over Twitter, and and I think I'd thrown it out there in a tweet like, want to come on my channel sometime? You're always welcome, kind of thing. And then randomly reached out, and she said, "Hey, we like your content. We think it, it's telling the story of the company accurately, and so we think you should do an interview with Daniel." So it was good. It was
good.
Unexpected, but
that certainly I think validates a lot of your analysis, at least from the company's perspective, that they think you're correct on a lot of your analysis. So that's, I think, important for people to realize that you're not just some startup YouTuber that's speculating and has no credentials. Not that you need credentials, but I feel like them reaching out to you or responding to you and saying that they've been following your analysis and they think it's accurate. That's a validation. So we wanted to bring you on here to talk more about Lemonade, and this is sort of a bull echo chamber, so to speak. I guess they're all kind of bullshit. We'll try to be point out some potential risks, obviously, and if anyone out there knows a good bear on Lemonade stock, we'd love to interview them. I tried to reach out to a gentleman from a hedge fund that shorts Lemonade, I believe, but I hadn't got a response. But let's just, I guess we'll dive into it. What are some of the key concepts, I guess, we wanted to make sure everyone's aware of is, like sometimes I hear the Lemonade discussions and I have to people throw these terms around so quickly and my brain doesn't always process it as fast as people are talking about it. But in-force premium, like what does that matter? Or PaperBagInvestor, do one of you guys want to kind of go over in-force premium and what loss ratio are? I think those are like two important metrics we'll probably be talking about, right?
I mean, I feel you can jump in or I can try and answer. I'm not an insurance expert by any means, so
I mean, I think we're trying to just set the stage for people who are maybe not as familiar with analyzing the financials. I think I've always been a bit of an industry generalist, and so there are a lot of terms that are very similar across industries, but certainly within insurance, there's a lot of unique lingo and kind of key financial metrics. One of them being in-force premium, which is probably the most fundamental. Maybe customer count would be slightly more fundamental than that, since it's kind of a bit of a lead up. But in-force premium is basically just the amount of premium that the company is essentially has under contract, right? And so watching that kind of grow over time, as it has done for Lemonade, is one of the best ways to kind of get a glimpse of near-term future revenue growth and how that would translate. I guess what are the other kind of metrics that you're watching, or what other kind of foundational metrics do you think are going to be important to share with the audience, just to make sure they're following us through the rest of this conversation?
I mean, understanding loss ratio is gross and net. Lemonade talks about loss ratio.
Now, what is that loss ratio exactly?
So I think like if you spend $1,000 on your car insurance, and but then or maybe not you, but a million people spend $1,000 on the car insurance, and then 75% of that is paid back to you in claims, or to whoever has a claim, then you're gonna have a 75% loss ratio. So a lower number loss ratio is better. And they kind of define, they have gross, because Lemonade has a reinsurance structuring built into their sort of their strategy. So they kind of have a gross loss ratio as if they didn't have any reinsurance, and then a net loss ratio if what they actually do have with their reinsurance structure in place. I mean, those are really important to look at. I mean, I did a video recently talking about the annual dollar retention. I talked about that a little bit with the annual interview. Where it's a metric they put out. I don't know if it'd be common in the insurance industry, but it's basically they look at if you look at a group of people at a set point in time, at least my understanding of their definition, and then 12 months later, you look at a group of people and all the premium they have at a set point in time, and then 12 months into the future, 12 months later, how much premium do those same people have? Not any new people, but those same people that were. And of course, some of them may not have any premium because they canceled their policies or left or whatever, and some might have way more. So in theory, your annual dollar retention could be over 100% if people actually got more and more. Got bigger and bigger products, like that cohort of people you're looking at. So that's a good one. From that, in that video, I kind of calculated what their churn rates could be at. So, customer churn is important to look at too. How many customers are falling off every, quarterly or annually. No, those are some of the key ones. I don't know if there's any others, but
So maybe at a more like fundamental level, what was your kind of original investment thesis with Lemonade, and then from there, I'm sure we can get into a lot of the specifics around churn and marketing spend and some of the concerns folks have raised, and kind of dive into those in more detail. But with broad brushstrokes, what was their bull case?
My bull case, and Daniel, I feel like did an interview that I did with him. I really tried to kind of like communicate this bull case, direct the kind of questions. Was really like, if you think about, like, if I tried to imagine what an ideal insurance company might look like, in the year 2022, I feel like Lemonade would be very close to what I would imagine. Like, if I never heard of Lemonade and tried just like had discussion with other people, like trying to like think about the future of what something could look like, Lemonade, it would be like probably better than I could have imagined. Place probably, and what that kind of looks like, or what the kind of the key thing is, they've for one, they're vertically integrated, so they're trying to do everything, which is maybe the harder thing to do, but longer term, has much bigger potential. So really vertically integrated approach, and then everything highly digital with and really trying to squeeze value out of that digital structure for the customer and for Lemonade, the company. So that that looks like you build this highly super digital structure, but then from that you're able to automate things a lot more accurately. You're able to, or a lot more quickly for the customers as they're signing up. You're also able to automate things and save on staffing and costs as an insurance provider. You're able to push a lot more efficiencies on the efficiency side for the customer and the company, and then also you're able to also potentially underwrite risk a lot better and find who could be risky, or who could be a risky customer you really should charge way more for, or who's a much safer customer you really want to attract to your business. But I don't think is possible if you weren't built on that kind of digital structure in mind, and we're pushing towards a kind of the large vision that they have for the company, which is a global company that can be anywhere in the world, that could have all kinds of niche products that are offered really efficiently at low cost, that can attract customers from any kind of stream that might need something like renter's insurance. So it's that. I mean, I think like the devil's in the details. It's it's easy to say, like, and a lot of shorts on Lemonade might say the argument against it is to say, like, well, like, who cares? Like, Lemonade has a nice app, they have a nice website, they have a nice chatbots. Like, that's really important to customers. Like, any legacy company can replicate, reproduce all those things really easily. But I don't think that's really true. Like, it's the details. It's the under the hood details they're talking about, that like they can use facial recognition for your your claims video to try and sort of improve that algorithm to say, like, to help prevent fraud, or to be like, okay, we're funneling.
And I think it's not that other legacy insurance providers couldn't adopt or implement any one of those things if they tried to. But I think the under the hood advantage is them building their own backbone infrastructure from the ground up, like vertically integrating the technology and the claims process, everything into their own kind of ecosystem, their own organically built platform themselves, and I saw that play out with Interactive Brokers for all my years working there, and the difference with Interactive Brokers and all the other brokers that we competed with. I always knew there was a huge, unique, embedded advantage in Interactive Brokers. Too bad the user experience was so terrible with Interactive Brokers, or it would be like so dominant by now. But even despite such a terrible user interface with Interactive Brokers that like it was never overcome, it's still a big dominant player because it's been able to be so cost effective and provide the best technology because it built its own backbone infrastructure, similar to what Lemonade's doing in the insurance industry. So that's what really checks the box for me. And I see a little bit with like Tesla. I know you're very familiar with Tesla too, and Tesla is vertically integrating their own. I mean, that's a different business, obviously, but the vertical integration, building it from the ground up yourself, is so advantageous. And I think you're right. I think, other folks who don't dive deep into it don't fully understand that. Maybe have to experience it to some degree, like I did, working in that industry of fintech versus insurtech. But I think that's going to be a huge advantage. It allows Lemonade to implement these things like facial recognition or whatever they change they want to make, they can do like that. Whereas the other insurtech platforms that are really just like white labeling the backbone infrastructure, the legacy providers, they have to like work with third parties and integration efforts to like get approval, and then the legacy providers have to move their dyno systems in the right way to adjust, and it's a headache and a half. They can certainly implement one or two things here and there, but they cannot move nearly as fast as Lemonade, as I think you were kind of implying.
Yeah, no, it's totally, it's all under the hood, actually, those details. It'd be like example, Tesla saying like, oh, Tesla just built like a digital car, in a sense. It's like Tesla built a digital car. That's like anybody could build a digital car. Like that's not a big, like that'd be kind of the argument in a way. But it's like, no, they're thinking like so much further. Like they're pushing like so much value out of that idea of becoming digital. It's like they put cameras and software and hardware in the car to potentially the car could drive itself entirely one day. It's like it'd be like versus another company. You make two teams, tell them to build a digital car to be Tesla, and like another team might come out with like, oh, it's just like an electric car and it's got a bit of software and like it's to me that's kind of the comparison. And like Lemonade's thinking of this grand vision, and if Legacy they tried to copy that, like it would turn out more like that, just like, okay, well here's a nice website, like we told the department to turn this out, like so they made a nice website and they talked to the underwriting folks a little bit too to figure out how they could overlap a little better, but it's not that sort of integration that we're talking about.
Yeah, and I think you have those different silos of a traditional industry incumbent, where you've got your actual sales agents, you've got the underwriters, you've got marketing and customer support, and those are all run on different systems with that are for the most part provided by different vendors. So if you were to try to implement something like this, it wouldn't be one kind of integrated software platform like you do see with Lemonade. It would be some sort of stripped down version that does only maybe one of the functions, and probably does that less poorly. Like, all the banks nowadays have like your virtual assistant that is like so limited in what it can do that it like you just never use it, but it's like they're all doing it. They're like, oh, look what we did. Like we're like a digital finance company now. And it's like, no, you just like
competing with Square now or Cash App.
Exactly.
Yeah.
So I think there is a distinction in the scope of what's being done on kind of the back of this one backbone, like we were talking about. But one of the other interesting things that they've talked about a little bit is kind of the way that they've incorporated a lot of like human behavioral kind of cues into the way that they've designed that. So that's something that has piqued your interest in the way that they've designed some of these, just like the way questions are presented, or like some of the I guess that just the way that the software does interact with the users and how that's evaluated and tweaked over time.
Yeah, no, it's it seems like some of those details, even those sort of artistic details, and how that's I mean, by artistic I mean more like simulating human kind of chatbots, and are again, I think just at a much bigger depth than others are. Is that something that's really piqued your interest too, I guess, or part of your whole thesis? Or
yeah, it's just, to me, it's they seem to have a very kind of laser-like focus on that user experience. And that's why I think you see kind of this crazy high net promoter score and this customer loyalty. But they're focused on like, okay, of like sub-screen 8 when somebody's going through a quote process, can we increase the response rate by 1% by changing this to a comma, or they're constantly kind of going back and drilling, and you just can't imagine like the AIGs of the world caring about
AIG.
Like, like some minutia little detail like that, and going back and kind of back testing that over time the way that you're seeing Lemonade do. And so I think it's this customer satisfaction that you see is a byproduct of that, and part of I think the bull thesis for me, and as I understand your bull thesis as well, it's in the long term when you've got this kind of young cohort of users who makes up the kind of core base right now, as they mature into more expensive products like Life and like Home, and then eventually over time, Lemonade's able to achieve a lot bigger scale and higher revenue per customer and more customers. The whole kind of revenue pie just explodes. Then that would be the point at which you can really see the benefit of all the work that they've done in the years before. Just minimizing the cost and how scalable this infrastructure that they've set up right now is. I think it's very easy to look at their financials quarter to quarter right now and be like, oh, look how much money they're losing. It's like not a great. It's like that's the easiest short thesis in the world to say, oh, look, they lost money, overvalued. But to me, there's just this huge amount of potential if they're actually successful in kind of scaling up, because they've got this just crazy backbone infrastructure right now that seems like it would be incredibly efficient if they can kind of solve that top line growth problem over time.
Yeah, absolutely. Yeah, I think even that kind of I think would even protect them from if they kind of reach that, I don't know if it's sort of an inflection point or something where they really take off, like just because they would probably have years of building up to that point. It'd be hard for even another sort of insurtech startup to just quickly kind of snap the fingers, follow in their in their footsteps. So that's why I feel if they reach that, if they're successful in that, then the sky's the limit. Kind of, there's huge potential. There's just huge global market they could just eat away into. So
I mean, I think, yeah, being global is a huge competitive advantage, and it's very laborious the way they're building it out. It's not like you said, something another insurtech can come along and just snap their fingers to reproduce, because building this backbone infrastructure A to Z, all the processes within it is not easy. It's not, you can't 3D print it. It's a big thing. A lot of systems to build on top of and work together. And, I just saw that play out in fintech for years with lots of other online brokers and such, and eventually all of them, pretty much consolidated into it, just a few now. But Interactive Brokers is still one of the linchpins. But I mean, the other thing is the Metromile, acquisition. That, I mean, car insurance is sort of like the big prize, right? I mean, if we're talking about life insurance, renter's insurance, pet insurance, all this other stuff that they've done. Renter's insurance is, I think, what they started with, but really car insurance is where their in-force premium, I guess, so to speak, is going to really tick up a few notches, right? I mean, how much bigger, how many multiples? Like, what's the total addressable market for auto insurance just inside the United States, do you think, for Lemonade, and like a realistic, estimate of yours within a couple of years, would you say, of going live in all 50 states with the Metromile acquisition?
Oh man. Yeah, I mean, I haven't really forecast that in detail. Yeah, do you guys have a number like you're thinking, or that's?
I don't have a number, but I mean, I've heard it quoted. I don't know the number offhand of, I don't know if Alec, if you researched it on the back end in Chatis or whatever, but the in-force premium for car insurance is nationally is many billions. I think it's hundreds of billions, if not tens of billions, if not over 100 billion. But you have to imagine they could start capturing even like 1 or 2% of that, and it more than justifies their current kind of market cap, you'd think, when you add on top of what their existing business is. I think the auto insurance to me is like, I feel like the big potential prize here for them to get revalued. And I think in an interview with the Motley Fool, Daniel Shriver said he expects, and he did at the end of November, expects it to be like 6 or 7 months until it's like officially completed. So maybe by June, Metromile and Lemonade will officially kind of merge, and they'll officially shortly after be able to go to market in all 50 states. I mean, that seems to be about the timeline. Is that your understanding?
That's my understanding. Yeah, no, yeah. And yeah, I feel like a year from now, like when we get results for Q4 2022, those will be really important, kind of, either the proof is there or not, or for them. After they've had, maybe 6 months of based across the US. I thought they were trying to roll out to some other states sooner. I almost sort of wonder if they're just testing the waters in Illinois right now until they go kind of 50 states wide, maybe. I'm not sure, but.
Yeah, so you put a Twitter question asking, and a couple of people answered, what was your findings of the people who are sort of experiencing auto insurance now? Did you come up with
I talked to one guy. I would like to talk to more people. He had he said it was, he has a Tesla. And I know they've said electric vehicles would be cheaper, or greener vehicles would be cheaper. So he said I think he said about half the price of Geico.
Wow.
So that's obviously very significant. He said he hasn't, the sign up process was super easy, A+. The user experience, asked him about that. He said was A+, that basically each driver has the app on their phone and he doesn't even worry about it. And it's not like he has to log in and say, I'm driving now or something, he just, it's something, something like that. I was asking him too, how much, I'm really curious to know, how are they pricing the risk of the driver? Is it really just you drove X amount of miles, so your risk, you sort of a risk per mile, or maybe you break down every road in, the country and you look at every road, maybe certain roads are more risky per mile than others. I'm sure you could kind of go that route, so then you see where you're driving, kind of adding that up. But then I'm hoping, it's my understanding, I think they'd be somewhat based on your actual driving, if you're you're stomping on it and swerving around curves, your rates could go up. He hadn't heard anything or received any feedback like that. I think it was pretty new still to maybe in the last month or two. It hasn't been out that long, but he was kind of thinking maybe the next maybe six months he gets reevaluated or something for his rates. So I said I wanted to follow up with that as things progressed, and he was definitely down for that. But I
think that's going to be one of the benefits of the Metromile acquisition, though, is that they do have so many millions of miles, I forget the exact number, but of real world driving data and kind of what behaviors are correlated with accidents. To me, it's very similar to what we saw with Tesla when they kind of introduced the safety score, where they developed those 5 or 6 metrics that essentially determined your risk of causing an accident. I think the number one was the percentage of braking that was over 1.2 Gs or something like that. So very specific metrics that are correlated over for in Tesla's case, billions of miles of driving data that they can say, okay, these 5 factors are cover, I don't know what it is, but maybe 80% of the variance of or of that R squared of accidents. And so if you can find whatever those those metrics are, and with good reliability, and can track those on an individual basis. I mean, that's just such a huge advantage relative to what kind of incumbent insurers have. So I think reading through the reading between the lines right now, like Lemonade clearly doesn't have great data on that stuff right now. They're just entering this market, with essentially no data. But in 6 months or so, when they've got access to everything that Metromile's doing, and kind of that existing backbone that Metromile's been working on for so long, and the fact that it's going to be built into so many OEM cars already, and you'll be able to just latch into a lot of those existing partnerships. To me, this is like such a brilliant transaction, because not only does it give you access to this data that would otherwise take years of kind of muddling through to get, and then you'd have presumably higher loss ratios when you were pricing things imperfectly. Instead, you're kind of accelerating all that, and you're getting all the regulatory approvals you need to kind of enter all these geographies at once. So as a shareholder, it's a really exciting acquisition, I think, to just see how quickly they're going to be able to get into this really large market.
Yeah, no, totally. Yeah.
One of the arguments, I mean, I've seen people make on Twitter or wherever, comments in our YouTube channel chats when we talk about Lemonade, or people, is that people say, well, Lemonade, how are they going to compete with Tesla insurance? Like, well, Tesla insurance can cover all Teslas. Well, what about all the cars that are not Teslas? In the best case scenario for Tesla, there's 75% of cars that are not Teslas that still need to get covered. And so Lemonade could be like an incredible de facto choice for all that potentially. And then I think also people unfortunately don't have a sense of what market capitalization means. Like Tesla's market cap is $1 trillion. Lemonade's market cap last I looked is like $2.4 billion. It's tiny, And I see Pierre Farragut, for example, talking about insurance just the other day on Dave's chat, and thinking it could be a couple $100 billion of market cap of Tesla's valuation just on Tesla's cars. If Tesla car insurance can be worth $100 billion plus just on Tesla cars, imagine if you have a really amazing technology for car insurance that are not Teslas, like how much could that be worth? So I think people have a hard time juggling two things at once. Like, okay, is Lemonade going to beat Tesla or not? But they can't juggle at the same time, like 2.5 versus 1,000 billion market cap. Like they can't mathematically comprehend the difference very easily as they're thinking about Lemonade's, potential versus Tesla's insurance potential. Tesla might even have a more superior insurance product already, like car insurance wise, I would say, like in kind of stealth mode already or whatever, just in a couple states they have it. And it might always be superior to Lemonade, but that doesn't mean Lemonade's car insurance can't be like the best car insurance provider for everything that's not Tesla in my mind. And even if it's like second place, it could still be multiples of where it is now, 2.5 billion market cap. I mean, that's tiny, like 2.5 billion market cap. And one thing that I noticed, Daniel Shriver mentioned on the Motley Fool interview that caught my mind from a month or two ago was, the revenue they take in, including their reinsurance premium. So there's like something kind of misleading because they can only account it on their financials in a GAAP accounting type of way. But if you include the revenue that they take in with their reinsurance premium, then they were like they were trading at like an 8x multiple or an 8 or 9x multiple at the time of the interview when the stock was $50 or $60, in between $50 and $60. Now the stock is like, 60% of that's going down by a third. And so now they're at like a 5 or 6 multiple, right? But they're growing, 40 to 60% a year, maybe even faster once car insurance kicks in. They're growing super fast. Whereas all the other legacy insurance providers, they're trading at 1 to 2x revenue, and they're not growing at all. They're flat, So for someone that's growing 40 to 60% a year, maybe more once car insurance really kicks in, having a multiple that's 5x versus 2x, that's pretty incredible to get that I think that deal right now. So I thought that was really interesting.
Yeah, no, I listened to that interview too. Yeah, no, and I found that I caught that. I listened a few times that one part to he was even comparing, like it's almost typical. Yeah, like your whole in-force premium almost, it can be like typically like maybe like factor 1 or 1 exactly what he said for like an insurance provider. So yeah, like they're 2.2 billion or something now, or whatever it is, and they're 300 and what's their premium going to be at? Yeah, 350 billion or 350 million. Sorry, last quarter. So yeah, no, it seems like a pretty good risk reward, pretty good multiple to get at right now. You just have, obviously I heard you say on Twitter, it's really like there's binary outcomes, the two sort of probable outcomes that either they're gonna fizzle out and fail, or you just could have phenomenal success. But I don't know, it's that's why the success, to me, all the qualities are there for the success. Like everything we talked about, it's like everything they're doing is just terrific, like how they've thought things through. And so that kind of points to the probability of success being there. And then the upside of success is so huge, or potential. Still seems like a good risk reward ratio that way. So it's,
and I think they have like 1.2 billion cash still on their balance sheet or something like that. And so they can go like a few more years at this rate potentially if they've kept losing money at the same rate, with that cash. Even when they did the Metromile acquisition, there was like enough cash on hand with Metromile for basically what they were acquiring it at, I think, or something. So it's like it's not like they used it was a stock purchase or whatever acquisition. Yeah, exactly. So they gained cash, even though they gained employees as well. But I would imagine they're probably, do you think they're going to, or maybe they're already in the process? Have you heard anything, or do you think they're going to terminate a bunch of the employees and consolidate, or do you think they're going to try to? Did you get any sense of that talking to Mr. Schreiber or anything? Or
no sense of that. That was no sense of that. I never read some of his, like, I think a blog post or something he put out when the car came out, where he talked about like they've looked at many potential acquisitions, but really this was like, kind of the match, that made sense. Like that really made sense, that they really saw eye to eye with the Metromile folks, I guess, or executives they're looking at and what they're thinking. So you'd kind of wonder if they would keep some people then, or retain maybe even a good chunk of them. I'm not sure what they'll do, but but like you said, Matt, they have they're gaining so much data and understanding there from the acquisition. So I'm sure understanding of that is in a lot of those people's heads too, and so I would think they would retain at least a good chunk of those employees. But just speculate, I'm not really sure.
Yeah, I'd love to talk about the bull case all day long, but I think there's I think there are some reasonable weak points that we've seen in their financials, disclosures in the last couple quarters. And I think you did a really good job in one of your recent interview or videos, kind of going through the customer churn calculations that you've come up with. So maybe for folks who hadn't seen that video, would you mind, just kind of sharing, what kind of triggered your dive into this and what you found, and what's maybe the bull and the bear case potential outcomes? I mean, like I said, it's binary outcomes. So where do we go from here?
Yeah, for sure. Yeah, no, I saw Dave and Emmet, you guys were chatting on one of Dave's videos about Lemonade, so I watched that and then just kind of did some thinking and reaction video to that, and Dave and Dave in that video was talking about just his concerns about their churn, like that. For him, the only way some of the numbers kind of made sense is that they must be churning a lot of people. So I'm glad he reached out to me on Twitter and then was sort of explaining his thoughts in that. And I did some more thinking and some math around the annual dollar retention to kind of see if we could figure out what the churn is. Based on my calculations, it's like they're turning around like a third of the customers per year. So I mean, there's only so much data. You're only looking back a few years' time, and so I mean that's one thing to consider. But it was so 35% on like a yearly basis, kind of like a year ago. If you had every 100 customers, a third of 33 of those, or 35 roughly, or whatever, are not there anymore. Obviously, it's concerning. Seems like a lot. Yeah, it is a lot. I mean, I think there's good reasons why that could be happening. Just because so many of their customers probably are renters, and they're trying to kind of like gather in customers at that stage in life. Like that probably is actually cheaper to acquire customers, I would think, because you're competing against people that are competing against a low, smaller sort of pie. So your average younger person that might be a renter, like they might be in school for a semester and they decide maybe they're in like an apartment or house or something, and they get renter's insurance and they go home and they cancel it, or they go like take a year off and do something else and cancel it, or they move to a dorm and they don't think they need renter's insurance. Yeah, like so it's like it makes sense the'd be major sort of
especially during COVID time, right? Especially during the last couple of years.
Even more kind of transition for people, or potential for that, potential for change, I guess, or uncertainty. So there's that aspect, and then there's also that they don't have enough. They don't have all their products everywhere if somebody might want it. I've had people message me, like on my channel, or just directly message me, kind of anecdotal, but saying like, I mean, I had Lemonade and then I canceled because they don't have a Lemonade car and the competitor offered a better bundled price, so I just switched there. So my thought is that as those higher value sort of products become more available everywhere across the board, and as customers that have used it at least once, even if they've canceled and went backpacking or whatever or something, like they're going to come back to Lemonade, or it's very likely. So that they should be sort of building a foundation that should spring off of in a major way. Yeah, exactly. But I mean, the numbers are still there. That they're still churning a major amount. I was looking at too. I think like maybe a key metric is their in-force premium they're gaining in a quarter versus the marketing they're spending. So every dollar, and that was that's I think it was. Let me just flip here. I think I have this open now. That was below like back to like 2019. That was below 1, that ratio now, but that is increasing. Has increased somewhat over time, probably as they're introducing more products, and they were more rather than just sort of renters back then. So we're at like a 1.18 last quarter, 1.36, 1.34, kind of in that range last few quarters.
So that's how many dollars they're spending versus the dollars they take in in-force premium or revenue. Is that right?
Yeah, that's like they're spending this much money and they're gaining this much in-force premium for the dollar they spent. So bigger number would be better. And in my mind, that number should like greatly increase if people like use the product once and then cancel their rental insurance, and but then now Lemonade car is available for them, and they're back. Their circumstances in life means they bought a house, so they got home insurance and their car insurance, and they jump back to Lemonade. They're basically getting those dividend kind of customers, right? Should pay off, which should like that ratio should increase quite a bit. I mean, it's sort of dependent too if what they're doing, kind of watching, like say they expand into Europe or other countries with just renters insurance, that could I mean, maybe that brings the ratio down because you're spreading out your net further. You're kind of, it's hard to sort of gauge when you're just looking at it as a whole company versus, maybe a market by market. So.
Yeah. I saw an interview, I think it was with Daniel Schreiber, where he was kind of discussing the churn that they've seen, and he said something to the effect of, like about half of the like lost customers that they see, they do these exit surveys, for people, and seems like about half of the churn is related to kind of life events, like you were saying, and the least common rationale was that they were not happy, or there was a lower price competitor that they switched to. So those are the sorts of like that kind of that all does sort of make sense, and you can kind of see it's very easy, I think, in my mind, to see two binary paths here, right? Like either these ratios don't change over time and they are spending too much on marketing. I was running some numbers too, and just looking at, it basically takes them like 2 years to get back their markeking costs, let alone like actually making money on something, because the average life of these customers is only 3 years if they're churning 33% a year. So like the economics of that marketing don't make any sense if they remain the same and in-force premium per customer doesn't change, and yada yada yada. But if the bull case does pan out where there are these kind of upgrades to higher price services and you see more bundling, or even if it was just that 1 out of every 4 customers like bundles with the car insurance product, well, now all of a sudden the $100 or whatever you spent to bring in that one customer makes all the sense in the world, because you just drastically multiplied your in-force premium just by adding in this one kind of higher priced option that you didn't have before. So like the risk reward on that to me just seems so attractive to say, okay, there's a good chance this doesn't work, but there's also a very good chance that like all this customer satisfaction that we keep hearing and all the data seems to be supporting can really have this kind of crazy multiplicative effect over time, where there's just this huge bundling impact. Customers are growing older, their economic wallet increases just because they get older and wealthier over time, which is just what happens. And thinking of how successful they'd be, kind of over 5-10 year time frame with those trends unfolding is just a really kind of encouraging picture. But it's the sort of thing you have to watch, because it could go either way in my mind.
Yeah, no, for sure. I feel like the most probable like short or bear sort of thesis would be that they just don't execute well at that. Like maybe insurance is like people as a whole don't care quite enough. Maybe it's as good as we think it is. It's probably better. We probably see that presently with the National Motor scores, but maybe people just don't care that much because like it's whatever. It's not that much better than what I already have. And maybe they don't execute well. Maybe their marketing strategies aren't as like tuned and dialed in as they could have been, or they're not as careful with just how they're spending money, and then have the faith or confidence they lose. Their funds dwindle. So like to me, it's all about their own execution. If that, kind of as we said earlier, I don't see somebody else just hopping along and like just quickly copying with the level of detail under the hood sort of details we've talked about. Copying them. If they are successful, like maybe some people will follow as in their footsteps, or try to, and maybe have some success, but I don't think it's going to like stop them as like a runaway train then. So, but if they really don't execute well themselves, that's that's the biggest risk, or where I could see that that failure, I guess, pan out.
At a $2 billion market cap, do you think there's a possibility they could be an acquisition target for one of the incumbents?
Yeah, I thought about that a little bit. I mean, maybe possible. Whether Lemonade would want to do that or not, or I'm doubtful they would, but they seem pretty they seem pretty set on building their own vertical stack, their own sort of ground up company doing this. We're headed towards this vision that we have. Have you guys thought about that, or?
It wouldn't surprise me if they've already been approached, multiple times even. It would be an interesting question to ask him if we ever had a chance to talk to him again. He probably would have to say no comment, but maybe you could kind of read in between the lines with how he says it or not. But I would certainly not be surprised at all if they've been approached and they just turned it down each time. And they kind of know they have that as like a backstop at some point if they ever have to. What do you think?
It seems like if it's going to happen, it would have to be now-ish, maybe in the next year or so. Kind of like Tesla back in the day. They had an opportunity to be bought out by Google, I think it was, and that would have been a very, very good deal. But now it's like they're just too big that it doesn't make sense. And I think it'll be something similar where this is probably a decent price point to acquire this backbone infrastructure that then you could kind of rebrand as AIG or whatever insurance brand, just with a cheaper infrastructure that they could scale. I think there would be pretty gnarly like culture clash if that would happen. Like it would clearly be like an outright acquisition where Lemonade wouldn't really have much say in how things panned out, so they'd really just be kind of buying this technology. So I think Daniel Schreiber and Shai wouldn't like that, but they do have a fiduciary responsibility. So somebody comes in and offers like a 80% premium or like a 60% premium on the current share price, like I think that'd be very hard to turn down, or it would go to a shareholder vote anyway. So I think if somebody wants to pay for it, they could, but I don't know that the incumbents are necessarily keen to kind of go with this full digital approach that kind of minimizes overhead expenses and
would disrupt their own business.
It would alienate their agents who are key stakeholders. I think that would probably be the biggest reason they wouldn't. Just get agent backlash, but I could be wrong.
Yeah, no, that would make sense. There's it's hard to see Daniel and Shai maybe doing that, but like you said, like if there was a major premium offered, it'd have to be considered. And and that's like I don't know if that's partly why it's hard to see legacy companies building something, like along these lines too, let alone just straight up buying something, just because of there's so many internal conflicting interests of different stakeholders and longtime employees and agents and things like that. That you're really disrupting. It's a major change.
One interesting footnote that a friend of mine recently disclosed. I mean, I'm pretty sure he's right, but the guy at Bailey Gifford, James Anderson, I think the kind of sort of famous portfolio manager of the Scottish fund manager Bailey Gifford, who was like a long time top shareholder of Tesla throughout thick and thin. Throughout the darkest times, this guy was like the biggest shareholder of Tesla and did very well as they kind of rose up after the share price rose later. But this guy is, I think, the biggest owner of. He's made, his fund is also the biggest owner of Lemonade stock, I believe. So that's an interesting sign when you have, sort of what's kind of one of those, legendary investors. I mean, he's not, solidified himself as a legend yet, but I wouldn't be surprised by the time his, career is over and disclosed his biggest picks, whether it's Tesla or maybe Lemonade's one of them, that he's picked some real huge winners over the years, sort of like Buffett or Peter Lynch or whatever, and this guy's a huge bull of Lemonade stock. So, that's an interesting data point. I think, they're not, he wouldn't, that fund wouldn't take a huge position if just off the cuff, they obviously have researched it and think strongly about the opportunity too. And also what I think is also really nice about Lemonade is the giving back, the giving to charity. So I think the way they have it is that for every dollar, of in-force premium paid, 75 cents of that is spent on, like 25 cents of it is basically targeted to be, gross profit or something for Lemonade, but the other 75 cents is targeted to be used for all their expenses and everything, and whatever's left over, they think they can be much more efficient than using just, they use less than 75 cents to obviously over time. And the difference goes to charity, and the customers get to pick the charities they want that difference to go to, which is a really nice kind of altruistic kind of capitalism. We talk about that in our channel with our firm and such, but I think it's nice to see businesses kind of get more hands-on with giving back. And that seems like a really excellent way for them to do it. So we really like, that's really just happens to be in line. That's not why we're investing, but it's really kind of fortuitous in a way that it lines up with our kind of thinking on evolving capitalism itself.
Oh, and I mean, I think they do it genuinely because they think, I mean, people care about that and they care about that, but they also, it's a really smart way to build trust. They're not, like Daniel said in a lot of interviews, they're not going to put their Lemonade logo on a dice scraper or pay for that or whatever, like as a way to kind of build trust with public. If you think about, there's kind of a third party between you, your insurance provider, and there's another kind of stakeholder being these charities that this fixed amount or locked up amount. So I think it's pretty flexible in there. Like, they could totally change or axe that if they even wanted to or needed to. I think it'd probably be something they keep going forward just for that. It's a good back end, and that is, I think, something a lot of customers would, if they were really close to do policies, they might go to that reason, and maybe they'll experience Lemonade offers as well. But a portion of your funds income goes to charity or something like that. So I was reading up about you guys a little bit, but
half of our fees net of expenses goes to charity. So we finally have some fees to delegate to charity. I think our administrators kind of putting the books together on that, and Matt and I hope to have a kind of video put together kind of explaining how we're planning to allocate that shortly. Excited to get that going. So I mean, I think that's that wraps up most of it. One of the fortuitous things also to note, just they raised capital when their stock was at $160 a share. That was the best time they could have timed. Like imagine trying to raise capital now, $35, $40 a share. They'd have to dilute it 4 times more just to get the same amount of money. So I think that was really incredible timing for them. I know they're also a top, not only the guy James Anderson and Bailey Gifford, but also the Motley Fool. I think Tom Gardner, it's one of his, it was, I don't know if it still is, but one of his top picks a year or two ago, and he's a big fan of the company and what they're doing. He's another kind of legendary investor, and he's picked some big picks over the years. So there's a lot of, I think, long-term growth investors that love it. I think ARK Invest has kind of gone on the record as saying they don't really see the value in Lemonade. I think someone asked them once about it, but maybe they just haven't had a chance to dive into it or for whatever. They're not always, they don't pick every great, they don't invest in Rocket Lab, and we love Rocket Lab, so we don't agree with them on everything. But I mean, we'll see how it plays out. It's like a binary outcome, like we said. Okay, so if you had to put odds on it, PaperBagInvestor, what do you think? The coin flips. It's in the air. It's a weighted coin of some degree. It's not 50-50. Tails. Lemonade's going to go bankrupt or get bought on pennies on the dollar from where it is now in a couple of years, when it dwindles away its cash and shorts beat it down to $10 a share or whatever, So tails is that outcome. Heads is it proves all the shorts wrong and we're winners, the investors, and 2 years from now the ship's turned around and the stock's going back up well north of $100 a share, and so forth. That's sort of 2 years. I feel like those are the two most likely outcomes, one of those two. What are your odds on either outcome? If you had to just like guess, if someone said, put a gun to your head, what's your odds? What's your over under odds right now? What would you say? For the tails versus heads. Just like your intuition.
I mean, it's just that. Yeah, I'd say like maybe like 2/3 to success. Like to the, I forget which one that was. That tails or to the
heads is success. Tails is the shorts win. Yeah.
Heads is okay. Yeah. 2/3 to the head.
Okay.
It's a 3-sided coin. 2 side is a It's a tail.
Okay.
I might put it like kind of around that. I don't know. Okay. So that'd be my guess. Just thinking about like just all the bull case you've laid out, all the under the hood deep there, and like all the rationale, all the customer feedback, all the opportunity that's there, even if Tesla incredible, which I think Tesla insurance could be. But there's still like I feel like Lemonade car insurance tastic, and still cover a large part of the rest of the market, which is a huge market, So you add up all those things, I think the ship's going
to 1/3
turn around.
Okay.
I would say my,
I'm closer to 50-50. I'm closer to 50-50, just because I know I'm biased in researching the bull case so much, and I would probably otherwise be like 65% bull case, 25. But because I know I'm sort of biased from researching the bull case so much more than the bear case, I'm going to discount it to be 50-50, which I still think is an incredible value at these levels to take a calculated risk on. Matt, what do you think? What's your odds? Just we'll end on this.
I am surprised on the ultra bull in the group. Like I'm probably more 75%. Okay. That the bull case wins out.
Okay.
I think it's already beat up so much, not that the current stock price has anything to do with the long-term kind of operations of the company. But, the only thing I think that could really, well, not the only thing that could go wrong, but that for things to not progress in the way that it seems like they should, like the net promoter score has to essentially like be lying or the core customers have to not progress up economically in the way that people in their early 20s typically do. So maybe it takes longer than 2 to 5 years for that story to pan out. But to me, you've got just like a product that the users definitely seem to love, and all the kind of right trends, which over time would point toward more use of more bundling and kind of higher premium for like a variety of reasons. So for just kind of the current trends to remain static and the company to kind of dwindle away its cash flow, like if that were to be the case, then I think they would just kind of like cut back marketing spend, and I don't know, it would be just trimmed back drastically. They'd float along over a couple of years, but I think I think it's unlikely. I think it's much more than a coin flip that the bull case wins out here.
Okay.
But I'm surprised that you guys are.
I'm surprised you're not. Usually you're more conservative than me on stuff like on a
lot
of
I usually ideas.
So. Yeah, but I still like the investment as a, that's why you don't bet the farm on something like this, because to me it's 50-50, but the chance that you're right, it's a much bigger gain than if you're wrong in my mind. I wouldn't want to be short Lemonade, that's for sure. Even if you thought it was like, if you were short and you thought it was like 75% chance it's going to go to $10 and then get bought out, like that, I would not want to be short knowing that 25% chance this thing could go to like hundreds of dollars per share in a couple of years pretty quickly. It could be a short squeeze. It's highly shorted right now.
Still a bad risk reward ratio even there.
I think like there's something like 35% of the shares are floated to are shorted of the float or shorted right now or something like crazy. So it's really, really crazy. So we'll see if there's signs of them turning this around the next couple quarters. Once like you said, I think it's a Q4 next year. Hopefully car insurance will be like, that'll be like the second full quarter of car insurance in all 50 states. You'll see some kind of signs, maybe another quarter or two after that at the most. But I would say by that point, there should be signs that create some kind of short squeeze to lift the stock off, you'd think. So we'll see. But we're excited. I wish I could press a button right now and fast forward and then come back in time and tell you what happens, but can't do it.
Bookmark this. We'll come back in a year and we'll see what happens.
For sure.
Yeah,
for sure.
Well, it's been a great chat with you, PaperBagInvestor. Thanks for all you do. Keep putting together that Lemonade analysis. I watch it when you put it together, and I know a lot of people do, and there's other folks who talk about Lemonade, and appreciate what you're doing with that, and we'll all stay in touch as things progress. So could be a long winter for Lemonade stock, but we'll see what happens a year or 18 months from now.